People think a debt crisis looks like a default, a missed payment, a dramatic headline, a sudden collapse. But the most dangerous debt crises don't start with default, they start with interest. Not because the country can't pay today, but because the cost of paying keeps rising and nothing else can keep up. This is the interest trap. And the United States is now testing the limits of it. Because when debt gets large enough, interest stops being a line item. It becomes a force. It changes budgets. It changes politics. It changes monetary policy. And eventually it changes what a stable system even means. This episode is about how a country can remain powerful, liquid, and functional, and still end up constrained by the interest on its own promises. Not a crash, a squeeze. And the only question that matters: when interest becomes the crisis, where does the pressure go next? To understand the interest trap, you have to start with the golden age. For decades, the US could borrow at low rates and roll its debt smoothly. Global investors treated treasury bonds as the cleanest collateral in the world. Treasuries weren't just debt, they were the foundation of the global financial system. Banks held them, funds used them, central banks stored them. And because demand was deep, the US had an unusual privilege: it could carry large debt and still refinance easily. That's the key, refinance. Most governments don't pay off their debt like a household pays off a mortgage. They roll it. When bonds mature, they issue new ones. As long as the market stays calm, refinancing is boring. But refinancing becomes deadly when rates rise, because then the government isn't just carrying debt, it is constantly repricing it. Here is the basic mechanism. When rates are low, interest costs feel manageable, even with high debt. But when rates move up, interest costs don't rise once, they rise again and again, each time old bonds mature and are replaced with new, higher-rate bonds. This is the slow-motion part. The system may look stable today, while the financing cost quietly climbs underneath it. And that climb creates a pattern we've seen across history. At first, higher interest is a policy choice. Later, higher interest becomes a constraint. Eventually, higher interest becomes a political crisis. Because interest is not productive spending. It doesn't build roads. It doesn't fund research. It doesn't raise wages. It is the price of past decisions. And when that price grows, it competes with everything else. Now we enter the escalation phase. The first mistake is psychological, treating low rates as normal. For years after 2008, the world lived with unusually low interest rates. Then after COVID, the combination of massive stimulus, supply constraints, and inflation forced rates higher. And once rates rise, a high debt system changes character. The government must refinance continuously. The market watches every auction, and the budget becomes sensitive to the bond market. This is where the debt story stops being about totals and becomes about sensitivity. The second mistake is structural, assuming deficits can be managed later. Deficits are politically easy in the short term. They let governments spend without immediate pain. They delay trade-offs. They protect growth during shocks. But when deficits become persistent, debt accumulates. And as debt accumulates, interest becomes the amplifier. Because the government is not just borrowing to invest, it is borrowing to maintain the system. At that stage, the debt becomes self-referential. You borrow more partly because you already borrowed so much. You issue more bonds partly because you must service the bonds you issued before. That's when a debt problem turns into a debt dynamic. The third mistake is institutional, believing monetary policy can remain independent forever. In a normal world, the central bank raises rates to fight inflation and protect credibility. But in a high-debt world, higher rates also increase government financing costs. So the central bank faces a conflict. If it raises rates, it tightens inflation, but it also tightens the government. If it lowers rates, it relieves the government, but it risks inflation and credibility. This is the path toward fiscal dominance, a world where monetary policy is pulled toward supporting public finance, not only controlling inflation, not because anyone announces it, because the system can't tolerate the alternative. And this is how the interest trap forms, not in one day, but across a sequence of choices that feel rational in isolation. Run deficits to stabilize growth, rely on low rates to make it affordable, assume refinancing will stay easy. Then wake up to a world where rates and debt are both high. At that point, the system becomes trapped between three bad options. Option 1, austerity. Cut spending or raise taxes aggressively to reduce deficits. This can slow debt growth, but it can also slow the economy and make politics unstable. Option 2, inflation. Let inflation run hotter than planned, so the real value of debt erodes over time. This reduces the burden in real terms, but it taxes savers and damages trust. Option 3, financial repression. Keep rates below inflation by using regulation and central bank tools to direct demand into government debt. This can stabilize refinancing, but it quietly shifts costs onto households and institutions. None of these options is clean. All of them move the pressure somewhere else. So why doesn't this instantly become a crisis? Because the US has powerful stabilizers. It issues the world's reserve currency. Its bond market is enormous and liquid, and global finance still uses treasuries as core collateral. That gives the system time, but time is not the same as resolution, because even in a reserve currency system, the bond market has limits. Investors don't only look at whether a government can pay, they look at whether the path is credible. They look for a story that ends. And an interest trap is a story that doesn't end easily. Now let's make the pattern visible. Imagine the government running persistent deficits while interest costs rise. More bonds must be issued. If demand stays strong, auctions clear smoothly. But if demand weakens, even slightly, yields rise. When yields rise, interest costs rise. When interest costs rise, deficits widen. When deficits widen, more bonds are issued. That is the spiral logic. It doesn't have to become explosive to become dangerous. Even a mild spiral can crowd out choices. It forces trade-offs. It turns politics into a fight over a shrinking margin. There is another layer people miss. A high debt, high rate environment creates fragility not only for the government, but for the financial system that holds the bonds. Banks, funds, pensions, and insurers hold large quantities of government debt. When rates rise, bond prices fall. If institutions are forced to sell into that environment, losses become real. So the system tends to do what it always does under stress. It avoids forced selling, it smooths, it delays. And delaying can work, but it often turns a sharp adjustment into a long plateau. That is why the interest trap is not a single event story. It is a regime story, a slow shift in how the system behaves. So what are the outcomes? A true default is unlikely in a system like this, not because it is impossible, but because there are many other ways to pay. The real question is not will it default, the real question is how will it pay? Through higher taxes, through lower spending, through inflation, through repression, through a central bank that eventually bends, and how much growth gets sacrificed in the process. Because the hidden cost of the interest trap is opportunity. It is what the system stops doing because servicing the past consumes the future. This is the lesson beneath the lesson. Avoiding collapse is not the same as staying healthy. A system can remain stable, liquid, and powerful and still become less dynamic over time. That is the trade. You can preserve continuity by smoothing shocks, but you may lock the system into lower growth, higher politics, and permanent friction. And once you enter that regime, it is hard to exit without a reset. So where are we in the pattern? If the golden age was the era when low rates made everything feel painless, then the current stage is the repricing stage, the stage where refinancing becomes the center of the story, where interest becomes the headline, not the footnote, and where policy options narrow, not because anyone chose them to narrow, but because the arithmetic narrowed them. That is what an interest trap is. It is not the end of the system, it is the end of easy choices. On this channel, we don't just tell history, we decode collapse patterns, step by step. Spain's silver boom, Britain's overstretched empire, the Soviet command system, Japan's long stagnation, China's plateau risk, and now the American interest trap. If you want to understand how powerful systems get constrained, not by a single enemy, but by their own structure, subscribe to Collapse Pattern. Don't just watch history happen, see it coming.